Tesla shares are down approximately 13% on the day, and they're approaching approximately $100 per share. So is now the time to buy the dip, or is there more pain on the horizon? That's what I'm going to dive into in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Let's dive right into this one because this is absolutely crazy news, because I had just published a couple of Tesla videos a couple of weeks ago, and I did warn that there could be potential pain on the horizon, because I felt that Tesla was worth as a company a little bit lower than its current share price. So it's kind of crazy to see the stock price decline so much, but it's not like I'm forecasting anything or I'm being Nostradamus on anything. It's not like the share price hasn't been declining over the past year or so, and so this is what I'm talking about. As you can see, this is the 13% decline that I was talking about today. But as you guys are well aware of, this is just a long line of the share price decline. But notice how it really started cratering post-November. And, really what that is that's when they started warning that they wouldn't make that 50% automobile delivery growth factor that they were forecasting earlier on in the year. And so that has really taken the stock down. But effectively what's happening is, if you were buying this stock at $400 per share, or if you were a bull on the security at $400 per share, you have lost 75% of your position. And so that's kind of crazy. And I don't fault people for believing in the story here. I myself have purchased securities, in the past when I was a little bit younger, where I focused less on the valuation, I focused less on building out a model, and I focused more on just like the story. And, I made those mistakes. Thankfully, those mistakes were well in the past when the portfolio positions were much, much smaller than they are today. Otherwise, I'd be crying as well. I'm pretty sure there's one YouTuber who said that he lost over $1 million on Tesla alone. I'm hoping that that's approximately a tenth or less of his overall portfolio. But if it's not, I'm greatly encouraging diversification in the future, because you never know when you could get it wrong. Now, let's dive into what exactly happened. So notice that Tesla came up short of their 2022 delivery target. They did not meet their goal of delivering 50% or more from last year. Now, the point that I wanted to make is that the 50% growth rate is pretty high watermark to achieve. However, let's give Tesla the credit where credit is due. Notice that overall, the company delivered 1.31 million vehicles, which is up 40% from 2021. So don't take anything away from Tesla as a company that was able to deliver, right? This is organizational excellence as far as I'm concerned. And, I'm using the word phenomenal. I don't really use that word that often, at least I don't think I do, and so I'm going to use that here. This is absolutely phenomenal. But notice that they signaled in October, so I stand corrected. I thought they did it in November, but they signaled in October that they would likely come up short from their target, and Wall Street actually moderated their delivery expectations. But I find that it's interesting that the share price crashed so much on news that should have been digested already and worked into models. And so what that is telling me is that there's a lot of investors, probably like retail investors, who are invested in the security that are not necessarily paying attention to the day-to-day guidance and news that's being put out by the company. Otherwise, they would have adjusted their models downwards. But the other thing is, it might be a read-through effect, right? It might be that people did adjust their models downward for 2022, but the read-through was, okay, there's just a hiccup because, the Shanghai facility was closed, et cetera, but we're going to go back on that 50% growth train thereafter. But I think some people are now realizing that 50% in the medium to long term is not sustainable. I probably wouldn't say long term, because that's more than like 20 years, but in the 5 to 10 year range, are they going to hit 50% growth year on and year out? I don't think so, especially not on a compounded basis. And the reason why I say that is, and I put it here, is that I think that the inherent economics in the auto business, and this is not just me saying this, Warren Buffett is on record to say this as well, the inherent economics in the automotive business are absolutely challenging. In one year, you can be the best-selling manufacturer, and in the following year, you can be dead last. It's difficult to predict year-over-year gains of 50% in vehicle deliveries over the longer term. And, I would change that to medium term, call it 10 to 20 years, call it 5 to 10 years. And so it would be very difficult to forecast that out. And so, now we're starting to see issues. So Tesla is facing a significant demand problem, as mentioned by Tony Scagoni, I can't pronounce his name, of Bernstein. And he said that the car maker may need to cut vehicle prices by approximately $2,000 to $4,500 relative to third quarter 2022 pricing levels. And he said that demand problems will continue until Tesla introduces a lower priced vehicle in high volume, which isn't on the horizon near term, he added. The other thing that I would add is as interest rates are going up, Teslas are still luxury vehicle purchases. And so people do have to finance these things. Well, as interest rates go up, it's just going to be more expensive to finance a Tesla. So once again, that would lead, people who would probably want a Tesla to purchase a lower priced electric vehicle. And here's where, the other EV manufacturers who are looking to sell lower priced EVs come in, and they could really take market share. And so, it's a scary endeavor for Tesla, but I do remember, now I know that this analyst said that there's no lower priced alternative on the horizon for Tesla, but I vaguely remember that they were going to release a lower priced alternative. You guys let me know in the comments what your thoughts are on the delivery of that promise in the next, 5 to 10 years. Now, I know Tesla bulls do get mad at me, and I just want to point out, what you guys are thinking, just to the people who are like anti-Tesla. It seems like it's like 75% of the people that watch this channel believe that Tesla shares are going to continue to decline because they're not going to hit that 50% growth rate. And then around 25% of the people believe that they will. And so here's the situation. It's hard to predict a slowdown with this company because when they just continue to knock it out of the park year over year. And so you can see, if you just look at the last 10 years, which also includes 2022, which is still a forecasted year, you notice that they have hit 50% plus in growth rate for sales in 7 out of the 10 years. Correct me if I got that wrong, guys. And so this is absolutely incredible. And the naysayers have to admit a miracle that Elon Musk has created here. And so is he really someone to bet against over the sort of like at least the near term? Unfortunately, guys, just because the inherent economics of the auto business, I revert to a quote from Warren Buffett. And guys, make fun of me if you want, but it's like if you put a great manager up against a lousy business, ultimately the business's reputation will prevail. And I do feel as though the auto business is not a great business. It would be closer to the lousy type of business. And so I think ultimately the economics of the business prevails. This is why in the medium to sort of like 5 to 10 year horizon, I'm not predicting that Elon Musk is going to get a 50% growth rate year over year, despite the fact that he's worked essentially wonders in the past 10 years. You can disagree with me, but this is just a matter of valuation. And it is what it is. We might just have to agree to disagree on this fact. And so unfortunately to the Tesla bulls, I'm in the camp where I have to taper expectations on revenue growth. And so notice that although I expect revenue to grow by 61% in 2022, I'm dropping that down to 25% in 2023. This is a result of higher competition and higher interest rates and, potentially entering a recession. So there's 3 things working against Tesla here. Then, 25% in 2024, taper it down again, and once again, taper it down. And so, revenue growth rate is going to go from around 60% down to, the high single digits, which is still pretty good for a company like Tesla. And so what exactly does this mean for the valuation? Well, you can see here that if you don't factor in a margin decline, which we haven't talked about yet, but I will talk about in the next part of this video, notice that if you don't factor in a margin decline and you do factor in a multiple contraction down to 15 times earnings, notice that they're trading at almost 60 times earnings right now, they are valued at approximately $100 per share. So you can say that that is a pretty reasonable valuation, trading at approximately $100 per share right now. So the dramatic decline in the share price should stem or should even out if that's how you value the company. However, unfortunately, guys, there's another risk here that I haven't really spent a lot of time talking about. I mentioned it a little bit in the previous video, but I do have to mention it here. And that is that the margins are expected to decline, especially if they're expected to reduce prices for these vehicles. But I just think, and I did mention this in the previous video that I did, that as they come up against more and more competition, they're going to have to take it on that top line. They're going to have to reduce the price of these vehicles. And so there's going to be pressure on those margins. Well, if there's pressure on those margins, and we expect revenue growth to decline as well, then what does that mean for the overall free cash flow generated as a percentage of revenue? Of course, it's going to decline. Well, if that declines, then what does that mean for the valuation as a whole? And so here's where the bad news is. And then once again, sincere apologies to the Tesla bulls. I'm sorry that you have to hear this from this channel, but I think a margin decline really impacts the valuation. And I think this is where I really sit on the valuation. I think it's a company that's worth $70 per share or less. And I wouldn't touch it for anything under $35 per share. In fact, I probably wouldn't touch Tesla at all because of the economics of the auto business as a whole. So, a lot of people are not going to like that, but this is just one opinion. I do my best. I value the company out. I break out each line in as much detail as possible, and I just tell you like it is. And of course, if you don't agree with it, totally cool. We just have to agree to disagree. Now, if you want access to that Tesla model where I've modeled everything out and I broke it right down to free cash flow as a percentage of revenue, you can actually get access to that model at the lower tier of the Patreon. And, we have a call this Saturday. So if you want to join us on an epic live presentation, you can join us at that upper tier. Now, if you missed that video on Tesla where I broke down the whole company, no problem. You can get access to that video right here.